As a stock started the week on a really good note this week, so we're going to talk about how bullish it is and what some of these other indicators are looking at in terms of whether they're at bullish levels and showing us good bullish trends. We are on a bullish trend right now. The question is again how long it lasts and what kind of high point it gets to. That's the key. So we're going to break that down and see just how bullish we are and what kind of near-term decline we had last week. Was that enough to get us a good new near-term leg to the upside? So we'll break that down in today's video and see the difference between what we're seeing in the S&P in terms of are we breaking resistance levels or not versus the NASDAQ and versus the Russell. Some very different patterns, and we'll talk about the implications of that. We'll also break down what's driving the price action today. It was very interesting what outperformed, what asset classes outperformed and which ones didn't. Some pretty significant outliers in either direction to the upside. That are also a reflection of the type of move this is, right? Even including how the sectors perform. So we'll break that down as well. And then our trade idea as a stock within one of these strong sectors that we've been seeing here lately. We'll talk about how to trade it, even though it's not on its own bullish trend yet itself. So what can we do with it right now? So we'll talk about that. Let's go ahead and get started. Today is Monday, April the 4th, 2022. This is the market outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. Look at that nice little rally closing above yesterday's high point, rallying back up. The short-term sentiment rallying back up on the market forecast. The intermediate line is still in the upper reversal zone, so still reflecting a strong bullish posture. Remember, we started this back at the March 21st, so right after March expiration. We have about another 2 weeks, this week and next week, till April expiration. So it looks like we might get this 1 month intermediate rally going here. Again, barring a severe drop to the downside. You notice we still haven't gotten below the 23% retracement level of a near-term decline. So that kind of shows, again, just how weak this near-term drop was. If it got all the way down the reversal zone but couldn't get below 23% retracement, then it was a really, really weak exhale here, which probably means we'll probably get a relatively weak inhale coming up. That doesn't necessarily mean we're not you can't be bullish. It just means that it's hard to get a strong near-term rally without even a normal exhale, which would be again down to the 38% retracement level, down below that the 38. We are back above the 62% retracement of the decline. So that's a good sign. Remember, that's a resistance level as we're rallying, and then getting up above the 78% line is what changes the impulse moves to the upside now, makes the pullbacks to the downside. So we're getting that much closer. We are 4% up above the moving average, the 30-day moving average down here at the bottom. The moving average itself is rising above the 38% retracement itself. So getting to the moving average would keep us above support from a Fibonacci standpoint. Would also probably keep you above this near-term support as well. The 62% near-term retracement's actually below the 30-day moving average. So pretty good opportunities for support from that standpoint. So now if we take a look at the NASDAQ 100, which is a lot more bullish today, 2% rally today, still within the range though of last week's weakness. This short-term sentiment did rally. We are in the 93rd percentile of how bullish we are in the past year. So 7% above the moving average, intermediate lines in the upper reversal zone. Short-term sentiments bounce back up. The near-term lines in bullish territory. They're not above the 80th percentile yet. Momentum lines in overbought territory, not exactly strong bullish, but at least it's above 80. And long-term market sentiments rising, the intermediate lines rising. We're still below its 62% retracement, so we haven't broken above it like the S&P has. The Russell 2000 is actually still below its 38% retracement of this decline. So it tried to get above it, really failed with a break back down immediately. Short-term sentiment was not very strongly bullish at all here, and then now you can see it's not even above 60 where the others are, and you're still below that 38% and the 23% retracement of the long-term line. See, the S&P is well above its 23% retracement. Here's its 23% retracement of the long-term bullish move, COVID low point. See, we never did break below that on the S&P. We did a couple times, just barely, but nothing significant, right? The Russell has broken below it, has been below it for a long time, tried to get back above it here and failed, and probably trying again. Right now, we're only 3% above the moving average, so not nearly as bullish from a percentile basis as the S&P 500 is. So that's the market forecast. Let's take a look at what the long-term charts are showing us. First, again, green, good bullish candle, rising PPO, positive differential. So bullish, and you have the green arrow, right? So we're bullish in all three respects there. We're not closing above last week's high point, so a little less bullish from that standpoint. So relatively weak, some weak. When you start closing below the prior week's highs, you start to grind, right? You start to grind down. You open yourself up to transition opportunities. The Nasdaq 100, you can see also the same three things. Green arrow. Well, actually, we don't have a green arrow on the. Yeah, we should. Let's see, where am I missing it? There we are. There's a green arrow. So we are above the 10-week moving average. We have a rising PPO. It's not positive yet, but at least it's rising. And then you have a positive differential that's actually below its moving average, which is, again, and closing below last week's high is a sign that we might be consolidating there on a weekly basis. The Russell 2000 doesn't mean we have to tank, right? So just don't assume that any signal that's not strongly bullish is strongly bearish, right? We can just be, weakly bullish or neutral, right? So there is those. I know we don't see that a lot on TV because it doesn't sell media ads. It doesn't get people to watch. But that's just the reality of the market that you don't see in financial media, because that's their job. Remember, is to sell advertising. If which is not a bad thing. That's a business model. That's just what their job is. If you notice here, we do have a bullish and open bullish candle, rising PPO, bullish candle, and again, not even close to closing above last week's high. And last week we didn't close above the prior week's high either, or the week before that. So the Russell's been really neutral, at least weekly bullish, right? And that also kind of lines up with the fact that it cannot get above this resistance level, which is a really, really important level for it, even though it has a positive, green arrow and, all of that jazz. Let's take a look at the 3 green arrow charts. Again, nice, lots of green shading, right? Lots of green shading, lots of 3 green arrows all across the board. We don't have a single red arrow yet. So that kind of shows you, again, just how bullish we are and that we are on a bullish trend. If you look at the 3 green arrows here, the S&P, so price got above the 200-day moving average, and so did the 8 and 17-day moving averages. So as long as we stay above the 17-day moving average, we are looking really good right now. Now, it's going to be another week or two before the 30-day gets above, and the 50-day especially gets above the 200. And that would really solidify a new bullish trend. So we're not quite there. The 30-day is not even above the 50-day yet. So we're not quite there yet. And the MACD is, slightly below its moving average here. So we are kind of set up for a bullish convergence. So where the MACD gets below its moving average and moves towards zero, and the stock itself stays above the 17-day. So when you look at the stochastics, it's also below its moving average, but they're both really, really high. They're both above the 85th percentile, and so really important to watch how the S&P performs relative to its 50-day. While we're kind of in this limbo between looking like we're bullish to not quite there yet with these longer intermediate term lines. So we're stuck in the middle. So while we're in the middle, it would be nice if we just stay above the 17-day as long as possible. That's the S&P. The Qs, this is a very strong move. The difference with the Qs is you're not above the 200-day moving average, and you're sitting right at the point of control here. And it's a great move off the 8-day moving average, but the MACD, the MACD histogram's already peaked. The MACD looks like it's peaked, and we're not converging yet. The stochastics kind of is. So we might be kind of stalling as we head into an important resistance level. Remember the weekly moving average here. You're sitting right at the 30 week. So we're above the 17 week. We got that long upper shadow last week on the Qs. We're trading so far this week inside that shadow. There's resistance up there. Not only resistance at the top of the shadow, but also at the 30-week moving average and also at the 62% retracement. So there's a lot of resistance in that spot. even though we are in a bullish divergence mode. MACD is above its moving average, and we are above the 17-week moving average. That's the Qs. The S&P is actually through all those lines. You see, again, above the 62, but not again. Still, lots of big, long upper shadow from last week's range can act as a resistance at the top of it, which again, getting through that and getting through the 78 will flip this thing around, right? But breaking back down and breaking back down below 23 means that we're kind of more, this rally is petering out a little bit. That's the Russell, that's the S&P and the Qs. The Russell 2000 got a little bit of an upper shadow last week. A little bit of a long upper shadow, again at resistance levels, really small body at resistance itself, barely above the 17-week, the 30 weeks below the 50. The MACD is a lot bigger, right? So it's more susceptible to peaking than what we had seen previously on this bearish move. Obviously not as big as these bullish moves, but that's the kind of bullish move you need to get if we're going to flip this around. And obviously the MACD is not to that point. It's not even above zero yet, the MACD itself. It's kind of hard to get above zero when you're barely able to get above the 17-week moving average. You are above the 17-week stochastic, or the weekly stochastics is getting above 40. So it's a relatively positive sign, even if the daily stochastics is converging, right, below its moving average while we stay above these short-term moving averages here. And heading, not only into those Fibonacci resistance levels, but also the bottom of this value area, which also will act as a resistance level. Directional movement index, S&P is still on a directional move, though the negative indicator is not below 20 yet, right? So that's kind of necessary. Same thing with the Qs, we're not below 20, even if we are above 25 on the positive indicator. And then IWM you see is not above 25 on the positive, it can't stay above it, and the negative is not able to get below 20 either. So we're not really that strongly bullish. The Ichimoku cloud looks fine. It's got an intermediate trend strength. We're above the cloud on the S&P, and we're trying to get above the cloud on the Qs with a good strong trend going. No trend at all right now in IWM at all, and we're barely above the cloud. Again, trying to work our way through there. So we're getting kind of some trends going on the S&P and the NASDAQ, but not really, right? These are not bullish signs here either. Slightly above 60, that's a good sign, but not above 100, much less 150 on the NASDAQ, and then the Russell is nowhere near those levels. So really neutral levels on a lot of these indicators. The S&P, and this is the problem, this is going to really weigh on the S&P in terms of its bullish opportunities, because the ADX is so high that it doesn't mean we have to go down, but it will just limit how fast we go up, especially when we're not in the upper quartile yet, and we never did get that breakout. Remember on the McClellan oscillator too, we never did get the thrust move up above a positive 100, because we never got below minus 100 during this whole decline on the S&P 500. So that's why we're really not. In fact, you can see the S&P as of right now. Oops, I wanted to show both of them, the bands and the Keltner. So look how wide the bands are outside the Keltner channels. So again, it's a great move. Like that's we can fill in that gap, but you can see the momentum is already petering off. There's probably a good chance that we just kind of level off going into April expiration would be my expectation at a best case scenario here. When you look at today's volume, the volume higher high, higher low, closing above yesterday's high, still within last week's range. Remember, there's a long upper shadow up there. Very, very light volume. That's SPY. IWM actually also closed slightly above yesterday's high, and so did the Qs. When you look at the volume on these charts, so go back to SPY, that's the lowest volume we've seen during this whole rally. 58 million shares trading hands, 4.65 was the range. So 4.65 is way down here. So it's slightly more than 1%. And what do we say? 58 million shares is way down there. So really, really light volume. Again, when we're trying to start a new bullish trend, we like the volume to stay up as much as possible until we kind of get into a month or two of this intermediate run. And we're 2 weeks into this intermediate run, and we're already really tapered off on both the volume and the range, and volatility. Volatility has really dropped down to extreme lows, 18.5, slightly below where we got to last week, but down to 80%. So really, this is an extreme level to the downside for volatility. And when you look at the the skew, which really like the trend really was extremely low, below 70 percentile. When we get these rallies and get it below 70%, it's not necessarily the best thing, but something to keep an eye on, of course. The skew remains very high. So the market still is very concerned about bigger moves, not quick not quick downside like the market's going to tank moves, but that's a really, really high level of VIX. The MACD for the VIX, which is the PPO here, is also at a relatively high level. So very strong momentum to get to this point. And you can see in that, like the last time the PPO dropped, the skew dropped, and the PPO dropped, that's when we peaked, when we got this high on the MACD. And you can see we got up here, got this high in the MACD, and on the skew, and we stayed bullish for a little bit longer, though that's kind of when we stopped the bullishness. We went sideways from that point. And you can see some other instances here too. We started some volatility at the beginning of last year, some ups and downs when this skew got really high at a high level there. And of course you can see some other major ones where we got really negative there. All of these really negative moves on the skew all coincided with an intermediate decline, and this really deep intermediate decline bordering on an actual correction on the S&P 500. Looking on the VIX on this chart, the VIX is at an interesting low point, well below the 200-day now. So we were kind of flirting with that, and then we got a big move. So that the VIX, the histogram has already bottomed, and it's been moving up. The MACD itself, it hasn't bottomed yet. It looks like it's trying to. It hasn't quite bottomed yet. And of course, you can see when the MACD itself bottoms, usually volatility follows, especially when it's so extremely low on the stochastics, and when it's so extremely low again on, you can see, so this would be at the beginning of the year, and this would also be in towards the end of October. So when you look at it on this perspective, and go back to a daily chart, so this would be the beginning of the year when we had the MACD as low as it was, right? So right in there, and then this would be towards the end of that October, where again we were at 15 and around 80%, both of these below 80%, and those ended up being some opportunities for volatility to rise. And you wonder if that's the case, if that's what we're going to be getting again, with the VIX already near 80% here, with it being so high still, and especially with the skew being as high as it is. If I were to go back to the skew here at the beginning of the year, it got relatively high too at the beginning of the year, right? So you had a high skew, high MACD, high skew with that low MACD on the VIX, right? And then the end of October would be right in this area. So the skew, this would be the 20th of October, was not so high, right? The MACD, it got high afterwards into November, but not there in October. So you can kind of see it's a very similar type of volatility setup now as what we had at the beginning of the year. And at the beginning of the year, we saw what happened after that type of setup was produced. So I don't know if necessarily we're going to start that tomorrow. I don't even know if we'll start that this week or next week. I think it will actually be after April expiration, because seasonally the markets tend to stay bullish going into April expiration. So I think we'll kind of grind neutral going into expiration here, and then I think we're set up for a move like we saw at the beginning of the year, another leg like that, potentially down to lower lows throughout the rest of this late spring. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that would suggest why you're either a lot more bullish than I am, or why you might be a lot more bearish than I am? Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen, hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. One, you liked our video today, and two, you want us to do another video again tomorrow. It's a quick way to give us feedback if you like our stuff. Of course, if you don't like our stuff, you don't have to click on anything. You don't even have to watch if you don't want to. Also, while you're down there, comment. What stood out to you in today's video? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us here on our blog, check out some of these things over here on the right. Click on this icon that takes you to this page. On Monday, Wednesday, and Fridays at 3:30 Eastern Time on this page, I do a quick 10-15 minute live video. I take a look at all the trades from prior Market Outlook videos. I also put on today's trade that you'll hear at the end of the video before the market close. So we take a look to see whether we should get out of trades, stay in them. We talk about them very quickly. When you can see all the old archives that we've got posted there as well. You can see our upcoming classes. Click on View More. That takes you to our calendar. A whole month's worth of upcoming classes and 4 years worth of recordings are posted here on the calendar. Come down here, hit that heart. It takes you to this tab. Hit that like button. Do the same thing with that thumbs up icon. Takes you to your Facebook page. Hit that like button. Again, the more you do that, it helps us get our content out to more of our followers. It reaches more people because of all the engagements. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here. Alright, now let's take a look at what's driving the price action today, and look at that. I mean, look at those three things that kind of work together there. The Qs, commodities, emerging markets, all rallying the most to the upside. Long-term bonds falling after having a pretty decent week last week. This is your, remember how last year that these three things were your risk on, your asset classes that were risk on, the Qs, commodities, emerging markets. Well, that's what we have again, right? They're back together. The band got back together today. The S&P is up 2, but not as much. The dollar was up strongly today. Let's take a look at some of these other asset classes. First off, like the dollar index, we'll take a look at it against the euro. Look at that big breakdown. So continuing late last week's drop with the stochastics crossing below its moving average and MACD looking like it's about to drop below its moving average. Again, this beginning of this year, the euro has actually been down. The dollar's been bullish during this kind of risk-off move, and we'll see if that ends up being the case here. TLT, that's not necessarily the case. Now, keep in mind the MACD is above its moving average. Stochastics is well above its moving average and above 60. And we're still not quite able to get above that 17-day exponential moving average. So we can't quite get going after being so bearish here. We can't quite get going to the upside. From a weekly chart perspective, you can see the MACD is pretty low. The histogram's already bottomed. The MACD looks like it's trying to bottom, and we're still well below the 8-day and that 23% retracement. So you can see the decline, and we're still below. We haven't started above that 23% retracement to really say that things have turned around. Bitcoin, again, one of those kind of strong risk-on asset classes. You can see it's above its 17-week moving average. Again, flirting with the 30, very similar to a lot of these other asset like equity classes here. When you look at the daily chart, you see how we're above the 200 but can extend away from it. So we're flirting with being just a little bit above the 200-day, still above the 8, but the histogram has peaked, the MACD has peaked. They look like they're rolling over. So now it's a matter of, are we going to get back below this 38% retracement and have essentially a fake out move and work our way through back towards the bottom of the range where there's going to be some very strong support, and of course breaking below that would be significant in its bearishness. So we need to see if this breakout will hold from a risk asset standpoint. The 10-year yield rallied today, but not very much. Again, within range of what we've seen. Remember, the yield spread inversion doesn't necessarily mean the stocks will fall. What it does mean, though, that long-term yields have a cap on them. It's really hard for long-term yields to really get going here to the upside because short-term yields are higher. That's the problem, right? That's the problem that they have. So you can see we're in a divergent mode. The MACD's below its moving average and falling. Stochastic, same thing. And we're still above the 8-day, much less the 17. So we're in convergence mode. We're not in bearish divergence mode yet. Still in this bullish. So we're still bullish, but we're not strongly bullish. The momentum is waning. We're in convergence, bullish convergence. So we'll again, that's what a yield curve inversion will do. It will cap how far up yields can go, 10-year yields in particular. And as we saw, it puts a cap on financial stocks as well. Speaking of, let's take a look at how the sectors did today. Remember, commodities, the Qs, and emerging markets were your big winners today, right? From an asset class standpoint. Well, if we look at how the sectors did today, not surprising. That's the Qs right there, and then you can see nothing else rallied up with it. Everything else was actually down to a degree. Was actually pretty negative to a degree. So again, that goes to show where the strength of the market was in. It's in these areas that, if I were to go back to when all of this started, all this weakness started, and we'll really just go back to this January 4th time frame. But this is when it all started, the weakness, right? They're your biggest losers, and they're right now the biggest gainers for a reason. They're still the biggest losers, and they're not close. So when we do get rallies, they should rally the most. They've got the most losses to recover from. So they will rally the most until we change the trend, and you can see that too in the sector rotation chart here. Here's the sector moves, but on a weekly basis, your strongest sector still, from a momentum standpoint, are still energy. Even though you're losing momentum, it's still down to a level that's higher than everywhere else. That's how strong the momentum was previously. And then utilities and healthcare. Those are your three strongest momentum sectors. And then your strongest relative strength sectors are staples, utilities, and energy from a relative strength standpoint. Even though staples is also losing momentum and has lost a little bit of relative strength too. So that goes to show how strongly bearish these three are, and how, again, you take whatever strength you've got with a grain of salt, because they're so oversold. They've got the most losses to recover, and just because they rally doesn't mean necessarily that they're changing the trend, as we see on this chart, that they're not necessarily changing the trend yet. You would at least start to see them. You would like to see them cross back up above the S&P, right, to get some relative strength going there, and they're obviously not. That's not the case yet, right? So they can still go up some more and still be in bearish mode relative to the S&P 500. All right, so while I might not be too gung-ho about being bullish in some of those areas, there is a good opportunity still to trade them. And one of the stocks in that discretionary space, Wynn Resorts, again, you can see the nice rally because it was so bearish, but it's kind of rallied back into neutral zone. I mean, all the lines, all four of them are in this neutral zone in the market forecast. You can see we were really bearish, but we're not anymore. We're actually more than 2.5% above the moving average here. You can see we've got some relatively bullish signs on this chart. It's not the strongest bullish, right? We're not closing above the prior week's high, and we don't have a green arrow yet, and you're just very small bullish bodies. But at least we're not bearish anymore. When you look at where we are relative to these moving averages, we are above the 17-day and have been for a while. We've gotten back into the 1-year value area. We're trading around the point of control. The MACD has been moderating. It's been bullish, but now it's kind of moderating here. You look at some of these other oscillating indicators. The RSI and CCI are in neutral levels, both of them in very neutral levels. The directional movement index has also have both of the indicators in neutral levels between 20 and 25. So we're not really going anywhere on this stock. You look at the trend strength indicators, very noisy and a really skinny cloud. So when you get a bigger cloud, that's a reflection of a bigger trend that we've been on. Very skinny cloud means we've been on a very sideways trend, not really much movement at all. That hasn't kept the Bollinger Bands from being strong. The Bollinger Bands have been really high. So within this sideways action, it's been pretty volatile, again, relative to the rest of the market here. But now you can see the bandwidth has been falling and potentially moving towards the lower end of its levels. And when you look at it with the Keltner channels, we're flirting with getting back. Whoops. No. I keep hitting the wrong one. We're flirting with getting back inside of the channels. You can see almost a red. When you get the red dots, that means your Bollinger Bands get back inside the Keltner channels, and that especially means we're not trending, and you can get that for a good period of time and take advantage of that. So especially when the Bollinger Bands are so high, you can see when it got this high last time and you got the red arrows, then it was a long time, right? So that's the kind of pattern we want to see again, and so we'll take advantage of that by selling an iron condor spread. So selling the 72.5 low 20s deltas, buying the 70. Over here, it's $5 wide, so you do two of these for every one of these to keep the risk equal. So you sell that low 20 delta, buy the 100. That's the trade you end up getting. This is what we already put in during the Market Outlook Live segment that I tell you about every time. All right, so there's our normal position sizing, and then our break evens you saw on the chart here. So our break even to the upside is at these old highs. Our break even to the downside is at the bottom of that big candle. Yes, we broke down below that, but you can see we gapped down. We only spent 2 days below it. We gapped right back up. So really the low point of that big candle is still support, and we have a break even right there. So I really like where this is set up right now. We have an opportunity for us to kind of stay in this sideways range and profit from it for a tune of, from a normal risk standpoint, about $450 or so. All right, well, that does it for me. You've heard from me now, and I want to hear from you. Use that link that's popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video down below. Remember, you can also subscribe to our website for free at marketscholars.com. Like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.